All right, let's take a look at a fairly basic little scenario here. The name of this exercise is constructing financial statements from transaction data. So looks like what we have going on here. We'll just read through the scenario and then I'll tell you what I think about it. It says Bayman Corporation commences operations at the beginning of January. Okay, so that's fairly important information because we are dealing with a brand new business. It provides its services on credit and bills its customers $30,000 for January sales, and these sales are to be collected in cash in February. Its employees also earn January wages of $12,000 that are not paid until the 1st of February. Complete the following statements for the month end of January. Okay, very good. So, a couple things that are worth mentioning here. We don't have a lot of information on either our income statement. We have no information, but we don't have a lot of accounts listed either. We're not usually going to have a sales or service revenue type account and then just have one expense account. That's not realistic, but that's not really the point of this exercise, so it's okay. And similarly with the balance sheet, we're not usually going to start off only with a couple of items populated. So let's see what we do have here, and then I want to say a couple of other things and we'll get going. The cash balance, $8,000, looks like somebody has started a small business. They put $8,000 into the business, into Bayman Corporation. That individual or individuals received common stock. Common stock, as we've said before, is one of the forms of owner investment. Okay, so right now, before we do anything, our owner's equity is $8,000 and it is made up wholly of common stock. Okay, so let's go back up to the scenario here, and it says that we provided some services on credit. Okay. So this is the accrual basis of accounting that we are dealing with here. Now, some of you might say, well, all accounting is accrual, meaning that it's cruel. Well, that's not what we're talking about. But we have two bases of accounting. We can have the accrual basis, which is as required by U.S. GAAP. And we also have something called cash basis accounting, which we're going to ignore for purposes of answering this question. So we provided services in the amount of $30,000. Well, if we've provided the services, we have earned the $30,000, and therefore, because we have earned this $30,000, we are allowed to book that to revenue, or in this case, sales. So I'm going to place that $30,000 right here. All right. So if we were thinking about this from a journal entry perspective, we would have a credit to sales revenue, which is, again, obviously an income statement account since we just put it on the income statement. But we did not receive cash, right? We did not receive cash. So instead, we're going to increase accounts receivable by that $30,000, the full $30,000, because based on the scenario, we did not collect any of that in the month of January, right? And so if we think about the definition of an asset, and accounts receivable is certainly an asset, current asset more specifically, an asset provides some type of future benefit to the company. Well, the future benefit here is that we're going to get to collect, hopefully, $30,000 in cash. Okay. Let's see here. it says that we also are going to pay our employees earn, very important word, earn. So I actually want to go back up here and I want to underline the word provides, because that means that we have earned the revenue. Well, our employees have earned January wages of $12,000. We're not going to pay them until February, but it doesn't matter. As soon as an expense is incurred, we recognize it. So because this is the only expense we have the $12,000 that we're going to plot right here. And I'm going to go ahead and put a little negative sign out here. And so we have net income of $18,000. We can't do anything more with the income statement because we don't have any other information. However, we do need to list total assets, so we're just going to simply add the $8,000 that we got from the owners of the business, and then the accounts receivable. We don't have any long-term assets yet, so we're just going to place that here. Okay. We have wages payable. This is our only liability of $12,000. Okay. And so let's think about this. Now, I'm not going to use negatives down here, and there's a reason for that, because we want to apply we want to look at the accounting equation in all of this. So we've got wages payable of $12,000. That's our liabilities. Okay. And then we have common stock of $8,000. And then if we think about it, this $18,000 of net income flows to the statement of retained earnings. And then if we subtract whatever we don't subtract out in terms of dividends, the remainder goes to retained earnings. So we don't have any dividends that I can see. So that means that this full $18,000 is going to go into retained earnings. And then we can simply add up liabilities of $12,000 plus the two components of equity. Common stock gets us to $20,000, and then another $18,000 in retained earnings gives us total liabilities and equity of $38,000. And if we wanted to write this, we would say 38,000 assets equals 12,000 liabilities plus, let's see here, what is that? 26,000 equity. The 26,000 is right here. Those two numbers added up. And that is all there is to it.